It's a perfect time, guys. We meet for this session. We are going to talk about financial analysis. So how you analyze statements in the financial reporting and analysis for CPA. So remember that we have two methods under financial analysis in the financial reporting. So we have the common size method, which contains the horizontal and vertical method of analyzing statements. Then now we have the second method, which is called ratios, because already I've done common size. Today I want to talk about the ratios, of which I did an introduction yesterday, or I can just mention a bit about ratios. But for today, I don't want to go in depth again introducing, other than doing questions. So I will be able to do 3 questions, 2 which have been tested so far since they introduced this topic in the financial reporting and analysis paper, then 1 question from the financial accounting, because there's no difference in financial accounting and financial reporting. The ratios is the same. In financial accounting, you did some times back when you were introduced to CPA, and the one they brought to financial reporting. But financial accounting, financial reporting, then advanced financial reporting are this. So they have a relationship. You start from financial accounting, financial reporting, then advanced financial reporting. So in financial accounting, you did ratios. So even in that syllabus, they are saying the ratios, which are the same as the one you did in financial accounting. So I will start with that question of financial accounting of May 2016. Then we check December 2021 for financial reporting. Then at the same time, December 2022. I think so. So I've shared all the 3 past papers with you in your WhatsApp group. So we can start with the first one. And make sure that you are muted. I don't want to waste a lot of time here. Muting you if you don't have any question. So for ratios, I've said I will start with the question of May 2016. Financial accounting, FA, financial accounting. So let's look at that question. Let's have a look at the question of May 2016. So for the May 2016, so this is the relevant question of ratios. So yeah, this is the relevant question. Question 4, May 2016, question 4. Remember, I'm talking about financial accounting. So I'm picking this from financial accounting. So they are saying that the financial statements of Pata Limited for the year ended at 1st March 2015, 31st March 2016 are given below. We have the income statement for the year ended at 1st March 2015, 2016. Then we are provided with extracts from the statement of changes in equity for the 31st March 2015, 2016. Then you are given the statement of financial position as at 31st March 2015, 2016. Inventory as at 31st March 2014 was valued at 64 million. Assume that all the sales were made on credit and each year has 365 days. Required. So the first thing they need is gross profit margin ratio, return on capital employed, current ratio, acid test ratio, inventory turnover, trade receivable correction period. Trade receivable correction period. So yesterday I said that you write down the notes so that you know the formulas. So I think you have done that, or you have the notes to this topic, which I shared to your group. That is the WhatsApp group. So let me start from the first requirement. So let me start from the first requirement. So in that question, they need what? They need So I could like to open this question in my phone, using my phone. Financial accounting, that is okay. So the first thing they need is all about gross profit margin ratio. So remember that we have to do this way. For us to prepare this well, this is what I will do. So here, remember we have 2 years. We have the 2 years. So we have the ratio. So I would have the first column for the ratio, so that we do it very fast. We have the ratio. So we have the ratio. We'll talk about the formula. After the formula, remember we have 2015. We have 2 years, and we have 2016. So the first ratio which is needed is the gross profit margin ratio. Gross profit margin. So what's the formula for the gross profit margin? You take your gross profit, you divide with what? You take your gross profit divided by sales,
Sales.
times 100%. And so you go now to your question, tell me the gross profit. You just go to the question for 2015, which is the gross profit? You go to the income statement. Your gross profit is given there, 180, 400. 180, 400 over the sales. Sales is 45. Sales. 450. 450. 600.
600.
And times 100%. Give me the answer here.
40%.
40%. So you do the same for 2016. It's all about 212. 100. You divide by your sales, which is for 8,500 times 100%. So here the percentage is
44.
44%. The next ratio, so this was the first one, number 1. So the next requirement was they need a return on capital employed. Give me the formula for this. Return on capital employed. The return on capital employed.
Net profit before interest and tax over capital employed times 100.
So net profit before interest and what? Profit before interest and tax. Net profit before interest and tax. BIT. Before interest and tax. Net profit before interest and tax over the capital employed. Over the capital employed times 100%. Who can be able to tell me how am I supposed to get the net profit? Net profit. And give me the net profit before interest and tax. That's the need for the first year. Then you divide with the capital employed. And obviously you multiply with 100%. Give me the net profit before interest. We can do here direct. I think it will be enough. So what would I do on this scenario? You looking at your statement provided, you have the net profit for the year. Net profit for the year, that is Yes, we have net profit before tax. Net profit before, but which they have already deducted interest. So meaning that we have to do what? We have to add back the interest because we have the net profit before interest and tax. So we have the net profit before tax. Already have subtracted the interest, which is the finance cost. So meaning that the net profit we have before tax, but after interest, to get the net profit before interest and tax, we have to add back the interest. So given 116,700 plus what?
Plus 10,300.
10,300.
300.
So you divide.
Mwalimu,
Yes.
why are we leaving tax out
Is net profit before interest and
and tax?
yes.
So that is 10,300. That's the interest. So we need to add tax.
No, this figure is
Okay. It's okay.
the 116,700 is
It's inclusive of tax. Yeah. It's okay.
so capital employed.
That's 127,000.
So capital employed is capital
That's
employed
not-
is capital employed. How do you get capital employed?
Total assets minus current liabilities.
Total assets minus current liabilities. Correct. So do that. Total assets minus current liabilities. Give me the answer for this one. Total assets 590,600.
Yes.
Minus current assets. So you go to your statement of financial position. Current assets, the value of the current assets. 60,000 plus 42,300 plus 23.
No, it's current liabilities.
Yes, it's total asset minus current liability. So not current assets. The formula written is correct.
4,600.
So current liabilities, and we use that formula. So total asset minus current liabilities, because there's something I'm sharing. The answer is for the current liabilities, add current liabilities, not give me the
125, 300.
125,
300.
125, 300. Then your answer you will multiply with 100%. You will tell me what's the answer there. Then for this side, just do the same. So for 2016, I will take what and what?
The percentage is 27.29%.
27?
0.29.
0.29%. Do 2016. Tell me what to do in 2016. Give me those values as I share something here. In short, I'm saying you tell me the net profit before tax. Net profit before tax is 137,
600.
600.
137, 600. Add back the
12,200.
that is 12,200. It's better to contribute so that you know what I'm doing. Then now, total as capital employed is total.
Excuse me,
Yes,
which question is this? Which year?
2016. Question 4.
Thank you.
The one I've shared in the group, the first past paper. See, I've shared. You are in the group. Are you in the group first?
Yes, but I've joined late.
The first one, the first past paper I have shared. I will do the first seminar.
Okay, thank you.
Mute your mic. Anybody is unmuted kindly, but if your mic is misbehaving, try muting. But if you are in a, then total assets 648, 500
Minus 170, 900.
minus 170
900.
times 100%. So someone is giving me an answer of 31.37%. And so the third one, the requirement number 3 was all about. They were in need of number 3 is current ratio.
Excuse me, sir.
Yes.
It is 31.
Or 31 or 13. 31. And thank you for the correction. So current ratio, the formula. The formula for current ratio.
Current assets over current liabilities.
So current assets over current liabilities. So you take your current asset over current liabilities. So from your statement of financial position, what's the total for the current assets? For the current liabilities we have current assets
104,600.
104,600. If you divide 125, 300. So you have
I'm getting 83.448.
83. This one is not supposed to be in a percentage. This one is supposed to be in terms of
1, 2. Okay.
so 0 point. So you say 0 point.
83.
3 to 1.
So 2:1. That is how you write this. The capability of the ratio of current assets meeting the current liabilities. So the business, how would be the business capable to pay debts due in 1 year out of the current assets? Will the entity be able to pay its current liabilities due in 1 year based on its current assets? This one for 2016, current assets. Total current assets.
126,500.
126. 126,500. For the current liabilities, we know here it's 170, 900. So it's a ratio of
0.74 to 1.
0.74
74.
to ratio 1. The next requirement was acid test ratio. And is someone who is having a lot of noise and is unmuted? I don't know, is this student? Sovia, mute your mic. Wairim.
Oh, sorry.
So acid test ratio. So acid test ratio is only that now you have to deduct inventory from your current assets. Then you divide with current liabilities. That is the formula. So it's all about current assets. You minus what? Inventory. You divide current what? Current liabilities. That is the case. So the current assets, 104, 600. You minus inventory from there. So we have the inventory of 60,000 here. So you divide with 125, 300. So this ratio says that are we liquid in meeting our current liabilities? And we don't have to depend on the inventory because the inventory might not be more liquid. So that is why we always deduct from the current assets. We don't consider it. We don't consider to rely on more on inventory in meeting our current liabilities, unlike using other more liquid current assets in meeting those current liabilities. So we are trying to measure how liquid are we in meeting the current liabilities. So we consider inventories to be less liquid. That is why we deduct it from the current assets. So what are you getting here? Give me the answers. Unmute and give me the answers. Know that when I said you mute, you don't have to give the answers. You have to unmute. It's only that you have to maintain a bit of silence.
0.3721.
0.3721.
3721.
0.3721. So it's a 37 to ratio 1. Then the other one?
Yeah.
The other one is
0.31 to ratio 1.
0.3 something, 3 what?
31.
And then we can continue 2015, 2016. I can squeeze. So we have the ratio, the formula. So 2015. So the next one, number 5 was requirement number 5 after the acid test. Inventory. Turnover. Give me the formula for this. Give me the formula for this.
Cost of sales of average inventory.
Cost of sales over the average inventory. So meaning that, remember that we have 2 years, we have even, our 2015 was ending when? 20. So we have 2015 ending. Our financial year ending was ending on
March.
March, 31st March.
Yes.
So we have 31st March, 2015, 31st March, 2016. And if there was a previous year, it could have been 31st March, 2014. So yeah, this year starts on 1st April 2014, and this one starts on 1st April 2015. So we need to know cost of sales. The cost of sales for 2015. So according to the question, is 270, 200. What about average inventory? So we have the inventory. If you check in the statement down there in that question, there's one sentence where they say inventory as at 31st March 2014 was 64. So you were given this, 31st March 2014, 31st March. So you are given 31st March 2014. Let me say this is the one which is, yeah, we have 2014, 2015, and 31st March 2016. So meaning this is 1st April 2015. This is 14. This is 13. So for the 31st March 2014, our 31st March, I don't know why my camera is not. So here we have 31st March 2014, where you are being given the inventory of 64. Then 2015, you were told this. So you are given for 2015, 31st March 2015, the inventory, 60. So you can be able to get the average. And the 2016 is the inventory in 2016, 72.
22.
So now how do you get the average for the ending 2015? You take the 2014 plus 2015 itself, which is 60. Average, you divide by 2. Then the answer you get, you take 270, 200 divided by the answer. So your answer is
4.36 times.
4.36 times. 4.36 times. So how can you explain about this? What does it mean when we say times? The inventory turnover. Why do we say times? Someone?
It's basically the number of times the company will be replacing inventory in relative to the cost of sales.
That is correct. So I said that it measures how often the company replaces its inventory. That is what you could have said. That the number of how often the company replaces what? Its inventory relative to its cost of sales. How it replaces its inventory relative to what? To the cost of the sales. 4 times in a year. 2016, cost of sales. Cost of sales is 268, 400. The average now you take that of 2015, which is 60, plus the 2016 itself, which is 72, divide by 2. How many times? How many times?
4.07 times.
Then the next one, after inventory turnover, the last one, by the way, the last one is trade receivable correction period. So we have the trade receivable correction period. The formula, the formula. I told you yesterday you write these notes. What's the
That's
formula?
average debtors over credit sales times 365.
Average debtors. Average debtors over credit sales, times 365, or anyway, let's know this. So the average debtors, you know the average debtors. You can be able to get the average debtors
Mwalimu, there's someone who has a question for you.
in the chart. Or where? Let me check.
Yes, in the chat.
Kind, how did you arrive at 64,000? So you are given in that question. It's direct. If you go to the question, there's somewhere they said that by the end of 2014, this is the inventory which was there. It's given here. Inventory as at 31st March 2014 was valued at 64. That is what I used. I think that was the question. So I used that. So to get the average for 2015, you take that one of 2014 plus 2015 divided by 2. To get the average for 2016, you take the one for 2016 and 2015, you add, you divide by 2. And then you take your cost of sales, divide by the answer. So average debtors, now do we have the one for 2014? We don't have. So meaning that for this one, I would just use the 42,300. The one for 2014, because we don't have the one for, the one for 2015. We don't have the debtors balances for the year ending 2014. So that I take 2014 plus 2015 divided by 2. The one which I would have the average is for 2016 because I know the one for 2015. So meaning that in the 2015, I would just use the one for 2015 itself because I don't have the debtors balances for 2014. So the debtors balances for 2015 was 42,300 over the credit sales. So credit sales. So use the revenue. So use our revenue, which is for 5,600 times 365. So how many days? Then now for 2016, that is when I will take 42,300 plus the 2016 itself. The debtors for 2016 is 51,300. I will divide this by 2 to get the average, then divide by the revenue, the credit sales. I will check my revenue, which is 480, 500. So how many days? How many days? The first one, remember here you have to multiply 365.
34 days and 35 days.
34 days and 35 days. What does this one mean? What does this one mean? When I say about days, remember it's trade receivable correction. So use even this to tell me what does it mean.
The number of days it takes to collect debt from debtors, to receive money from debtors.
Yes, it tells how long it takes after credit sale to receive payment. How many days it takes after we make a credit sale to receive payment? 34 days. After we have made what? A credit sale. How long will it take for us to do what? To recover. That is to receive the payment. So on these 2 consecutive years, was the debt correction department more efficient or inefficient? Because the days are increasing to 35, so they were not more efficient because the days 2016. If this the debt correction, the debt correction, let's say department, if it could have been more efficient, the 2016 days could have gone down even to 30 days. But now we are seeing these days are increasing from 34 to 35 days. So that was the question. That is how you are supposed to do the 5 ratios: gross profit margin, return on capital employed, current ratio, asset test ratio, inventory turnover, trade receivable correction period. So let's look at another question from my FAT.
A
December.
question, on writing the number of days, do we put like now 34.2 days, or we just write 34 days?
34 days, full. Whole numbers, that is. You write in all
34
numbers.
days.
All numbers. We have half a day.
Even a year's a quarter, 364 and a quarter days.
Those are leap years. A leap year. Leap year.
Yeah.
So our second question is December 2021, question 3. So let's look at that. December 2021, question 3. So under this question 3, they were saying that various analytical tools are today utilized in the financial statement analysis. Some of these tools include ratio analysis, trend analysis, common size financial statements. In the context of the above statement, describe how each tool is utilized in practice. How is ratio analysis used in practice? So are you seeing this? Tools utilized in financial statement analysis. I think you are seeing what I've shared now. The one I'm reading, tools utilized in financial statement analysis. Yes or no?
We are seeing the question.
Oh, you are seeing the question. That is good. So these notes, you have them. It's only that we can go through together. Now I think you can see them. So ratio analysis. So they were asking about the ratio analysis. How is it used? So ratio, it's an expression of mathematical relationship between one quantity and another. Like now, see, here we were doing the analysis between which year and which year. The question we have done, the mathematical relationship between which year and which year?
15 and 16.
15 and 16. So if a ratio is to have any utility, the element which constitutes the ratio must express a meaningful relationship. So that is why in some cases I tried to explain the ratio itself. Like now, in terms of a return on capital employed, you can be able to see the shareholders value from 2015 to 2016 based on the equation we have done. So using the ratios, you would be able to do the analysis to disclose the relationship, which reveals conditions and trends that often cannot be noted by inspection of the individual components of the ratio. So typical ratios are fractions usually expressed in percentage or times. So we have done some expressed in fractions, right? Which ratio was expressed in fractions? Two of them.
Current ratio.
And which one? Current ratio. And the other one is acid test.
Acid test.
Trend analysis. So how does trend analysis? Trend analysis indicates a direction in which a company is headed. So trend percentages are computed. So this is like a horizontal common size. So the trend. So yesterday we did this. So trend analysis indicates a direction in which the company is headed. So trend percentages are computed by taking base year and assigning its figures a value of 100. So figure generated in subsequent years are expressed as a percentage of base years numbers, of which our initial year, we said is the base year. So we said that yesterday. Common size financial statements are prepared on the basis of base index for comparison purposes. And then there's attributes of a good financial statement analysis. This one, even you could have used the word SMART. Specific, measurable, attainable. So the one we use in leadership and management, of which I know you have not done that. So anyway, attributes of a good financial statement analysis, it has to be objective. So results of the financial statement analysis should be analyzed objectively to reduce the possibility of any behavioral bias to minimum. So there must be objectivity. Precision, something which must be precise. So financial statement analysis should be done with precision, understandability. So they have to create a meaning. Information provided by a financial statement analysis should be presented in such a way that the analysis fosters understandability. We have relevance. Analysis statements used in analyzing should be timely and should have a predictive value, and there must be reliability. So we can do the calculation part. The theory, you have it. You have even this marking scheme, by the way. It's only that now we have to discuss here for you to read. Imagine. You know that. You have all these materials with you. Anyway, let me do my work. Also, you will do your work in 2 weeks' time during the exam.
Mwalimu, don't rub it in.
Yeah. Anyway, I wish you all the best. I wish you all the best coming next week. Coming what? Next week or in 2 weeks' time? In 2 weeks' time. So,
can you please share that answer?
Gideon, how are you?
I'm good.
How is Rwanda? Kigali?
It's a good. You're praising that.
Oh, you are doing well.
Yeah.
Gideon, by the way, I shared these materials sometimes.
No, I can see
Long
it.
time ago.
Oh, it is there, but this one I can't see it in the group. This one, this December 2021. But
It's not
others I
there?
can see it, it is there, but this one I can't
Oh, I
see
will
it.
share. I will share then. If it's not there, I will check and reshare.
Yes, please.
So we are doing C. So which means that we have answered the first two, 6, 10, 6 plus 4, that is 10. So now you are ready to get another 10. So the following are extract of financial statements from the books of Sawad Remittance. So we have the extract of the income statement for the year ended 30th April 2020 and 2021. Then we have the extract of the statement of financial position. So assume 365-day financial year, analyze and interpret the performance and the visions of the company for the 2 years ended 30th April 2020 and 2021 using. So then you analyze and interpret the performance. So when doing the gross profit margin, you have to talk a bit about what you have done. The same with return on capital employed, inventory turnover period, trade receivable correction period, trade payable payment period. Those are 5 ratios to be done. Let's do them. CPA. So we have 2020, 2021. 2020, 2021. So we have the ratio. We have the formula. Twenty 2021. All right. So the first one, so gross profit, that is gross profit margin. Gross profit margin. So now, so you know the formula, which is the gross profit over what? Over?
Sales
Over
times
sales.
100.
Times 100%. And the gross profit for 2020, 103, 812. Over the 4 what? 476, 200 times 100. Give me the answer for this. And this one is gross profit is 100 and
That's 22%, 2020.
22%. And this one is 179.02 over what? 701, 800 times 100%. So that is
17%.
17%. And the gross profit margin. So what does this one show? So if you want to explain here, you say indicates. What does it indicate? Indicates what? So indicates the percentage of each, what? Each shilling. The percentage of each shilling of revenue. That the company will do what? The company retains as gross profit. Indicates the percentage of each shilling of revenue that the company retains as gross profit. Now here it was going down. So meaning that the company is not doing well. So from 22% to 17. So like now here for 22, I would say that expressing myself in terms of the statement I have provided, because I've said it indicates the percentage of each shilling of revenue that the company retains as gross profit, as gross profit. So what do I mean when I say 22%? For every shilling of revenue generated, for every shilling of the revenue generated, for every shilling of the revenue generated, shilling 0.22, shilling 0.22 is done what? Is retained, while 0.88 is done what? Is attributed to the cost of goods sold. Because we are retaining 0.22, while this one is attributed to what? For us to have one, 0.88 is attributable to what? To the cost of goods sold. So for every shilling of revenue generated, we retain what? 0.22. Then 0.88 is attributed to the cost of goods sold. So here it was going down to 0.17. So meaning that we are not doing well as a company. So that is how we use ratios to analyze statement of a company. And number two, ratio number two. Number two was return on what? Return on capital employed. The formula, profit before, see, it's all about, profit before interest and tax over the capital employed over capital employed times what? 100%. For now, you know this, how it's supposed to be done. So let's do it very fast. Profit before tax plus the interest, which has been deducted already. Profit before tax. Students. I will finish this semester, and I know some students would be very silent. They have never contributed.
It's 50,000. 50,008.
I don't know even them physically. 50,000?
850.
850. So this is now profit before tax.
Tax.
But now, remember that they have already deducted interest. So we have to add the interest. So which is 72. Then capital employed, we said is total assets minus what? Current liabilities. That is the capital employed. Total asset minus current liability. I know for the guys who are doing FM, already you have done ratios from far. So if you have not done ratios, we have already covered that. Yeah, you don't have to do it again. Or it's different from what you do. FM, what were FM? Our capital employed, total assets. Use your calculators, Buana. Total assets. So you can see you have a non-current asset and you add with current 1,018,140 plus 236,695. What are we getting? as your total assets?
1,254,835.
1,254,835. You minus current liabilities, which is given. I think it's current liabilities. Is it given? 179. 179. 835. So yeah, you have to do what? To multiply with 100%. Give me the answer. But this one is done in a percentage.
5.4.
5.4%. And so the other side. So this one is let me check. So profit before tax, which is 42,960. Plus the finance cost, 10,800. You divide total assets is just adding 1,881,500 plus 335,500. What do you have? What are you getting?
17,000.
22?
17,000.
17,000. You minus, so your current liabilities 297 times 100%. What's the percentage there?
2.8%.
2.8%. A return on the capital employed. A return on the capital. So the return we are getting on what we did what? On what the shareholders did what? Pumped to the business. Is this company doing well in terms of the shareholders' value?
No.
The return on capital employed is reducing from 5.4 to 2.8. So you talk about here you talk about the shareholders' value, which is not in a better position because the return on their capital is going down from 5.4 to 2.8. So the third one.
A question, Mwalimu. What's the difference between the return on capital employed and return on equity?
Return on capital employed and return
on equity.
Equity, it will focus on specifically because what do you get from the equity? Your return from the equity, it's dividends. But here, return on capital employed, capital generally the profit you are getting, and under equity we focus on the dividends the shareholders will be getting based on the shares he has in an entity. But here we are talking about the profit, because we are using what? The profit which the entity is generating, not the shares which we have, so that we can be able to focus on the dividends. So the third one was?
Excuse me, sir. Is return on equity the same as return on investment?
Return on investment. Return on investment. Yeah, that one is the same. Return on investment and return on equity. Those are the same.
Mwalimu, I don't think they're the same.
Return on investment and on
yeah, it's just net profit after tax over the total assets multiplied by 100
So
And
this is
the
the
return ROI, yes. And
ROI
then the
and
return
ROI.
on equity, it's against the total equity strictly. So it's the profit plus the preference dividend. We divide with the total equity. So there's a slight difference on the aspect of preference dividends.
But this one is it in what we are doing here in FR, or it's more of a FM? Is it in the last part of the categories of ratios? Remember we talked about various categories of ratios. This one lies under which category? Hmm? Anyway, we can do more research about this. I will do more research about that. I will come with a conclusive answer maybe.
I think they're part of the profitability ratios.
It's true.
So ratios are many. So in this question, our third ratio was inventory
turnover period.
Inventory turnover period. So what about this? Inventory turnover period, what about it? The formula, average inventory. Average inventory over what? Over cost of
Sale over
65. So do we have the inventory for the end of 2019? We don't have. So meaning that for 2020, we use the one for 2020, which is 81,000. Cost of sales is?
Mwalimu, is the formula correct? Isn't it the reverse? Cost of sales over average inventory.
Sorry?
I'm asking if the formula is correct for inventory turnover period.
Yes, it's correct. Inventory turnover period. Remember, it's inventory turnover period, not inventory turnover.
Okay.
It's inventory turnover period. And there's that inventory turnover. When we talk about inventory turnover, that is when I say cost of sales over what? The average inventory. So 81,000, you divide what? Cost of sales. So the cost of sales, which is 372, 388 times 365. What do you have? How many days? Then now this one for 2021, since you have the one for 2020, you take the one for 2020 plus the 120 for 2021, which is 84,000. You divide by 2. And from there, you divide your cost of sales, which is 583, 898. Then you multiply with 365. So your answers?
The inventory is not 84, it's 81,400.
This one is
For 2021, yes.
81.
Yeah, 81,400.
81,400. Not 84, 81,400. So the answer, the others are correct, I think. So 372. So the number of days,
79.
79 and 50.
79 days and 50 words.
50 days.
Remember, they have changed
50
this.
days.
They have changed this. You have used 84, 81, 400.
81, 400.
Also meaning this one is 50.
Yes.
50 days. $50 days.
Is it 50 or 51?
So it matters now what you tell me according to your calculators.
50.75.
Yes, 50.758.
So
51
51.
days.
So remember, it's inventory turnover period. So this one indicates what? The number of days it takes to sell the inventory on hand. The number of days it takes to sell the inventory
In hand.
on. So meaning that the company is doing well in the year 2021 compared to 2020. So which one is remaining? There were 4 or 5. So trade receivable correction period. So ratio, need the formula. 2020, 2021. So Wairimu. I don't know what you are opening. It's making a lot of noise on the other side.
Sorry.
So
Trade
the next ratio,
receivable.
trade receivable, correction period, trade receivable correction period. So the formula, we said it's all about average
data of credit sales
over the credit sales. Times what? 365 average data. So remember that for 2020 we don't have the data for 2019. So we just use the one for 2020, which is the data for 2020 is 95
to 40.
240. Divide the credit sales, just revenue, sales revenue, 476, 200 times 365. Then now for this one, we take this for 2020, 95, 240 plus the one for 2021, which is the data for 2021, 175 for 50. 175 for 50. You divide by 2, over what? Over the credit sales, which is the sales revenue, 701, 800, times 3 what? 365. And so the answer is here in the year. Days.
73, 70.
73 days.
70 days.
70 days. So you know the meaning of the trade receivable correction period? So we talked about this in our previous question. So the last one is, the last ratio is trade payable.
Trade payables payment period.
Trade payables payment period. So you take your average payables. Average payables over what? Credit purchases times the days, 365. So the payables for 2020, 111,715.
Yes.
Credit purchases, cost of sales, approximate what?
2388.
So 372. So they have said cost of sales in brackets, approximate purchases.
Yes.
372, 388 times 365. So give me the answer there. Then this one now, you take the one for 2020, which is 111,715, plus the one for 2021 itself. So the payables for 2021, 204,365. Over the credit purchases, which is approximate, which approximates, that is our cost of sales approximate purchases, which is 583, 898 times 365. Give me the answers. Give me the answers.
$109 and 99 days.
109 days. 199.
Yes.
Yeah.
So this one does, what does this one show? Trade payable payment period. The number of what? Times the business is paying off its what? Its creditors, based on the credit purchases they made. So the number of times the business is paying its suppliers or its creditors. So your suppliers are the one who are called the creditors. I think you know that. See, the days are reducing. So meaning that in meeting our obligations as the company, we are not in a bad position because now we are paying our suppliers in a good way in the year 2021 compared to 2020 because these days are reducing. The third question is you can do it or you cannot do it. So let's look at December 2022 question 4A and B. So this is the relevant question. So they were saying that the ratio analysis has over time to be a useful Ratios as over time proven to be useful financial tool for decision making. Which is it? However, reliance on ratios for decision making has an inherent limitations. Citing 6 limitations, justify the above statement. Which are some of the limitations, you know? We mentioned
Uses historical data.
Sorry?
Ratios uses a historical data, and so it may not be very accurate in forecasting the future.
Yes, we talked about them yesterday. Another one, we mentioned a few yesterday.
Like the one we are having now, having a difficult time to interpret the ratios. It needs experts.
Yes. It is okay. Another one, we need 6. That is 2.
Can you say it is subjective?
Oh, yes, it's include mathematical computations. It's quantitative. Another?
It ignores the qualitative aspect of the information.
Yes, because it's quantitative, which is okay. So there are many, besides the one we mentioned yesterday, there's ignorance inflation, ignore qualitative aspect of the farm. Ratio does not consider time value of money based on historical costs. So those are the limitations. It does not consider the fluctuation in values caused by seasonal trading. Interpretation of ratio changes according to the circumstance of each case. So there are many. You can see some on the screen. So let's continue with the second part of the question. So the foreign draft financial statements were extracted from the books of Mrima Limited as at 31st December. Statement of profit or loss, statement of financial position. So here now, I don't want to do them, but this is your assignment. But we will be able to interpret, like now, calculate each, for each year, 2 ratios. For each of the following calculate for each year 2 ratios for each of the following user groups, which are of particular significance to them. Which ratios can you calculate for the shareholders? Which ratios will you do for the shareholders?
Return on capital employed.
Current ratio.
So for the shareholders, so I would ask you that you do which one and which one? So you have seen the student has said the first one.
Return on capital employed.
Return on capital employed, and another one.
Current ratio.
Current ratio. Shareholder. So in my case, I will ask you to do earnings per share ratio. Because now here, focus on, when you are talking about the shareholders ratios, focus on the investors ratios. Investors ratios. So because for the investors ratios, they measure the return the company will give to the owners. The return the company will give to the owners in terms of cash returns generated by the firm. So do the earnings per share. How do you get the earnings per share, the formula? How do you do this? EPS is equals to earnings
earnings over the number of ordinary shares.
Total earnings over the total number of ordinary shares.
Earnings attributable to ordinary shareholders.
Yes. Over
Earnings-
total number of ordinary shares.
Earnings attributable to ordinary shareholders over the number of
Total number of ordinary share capital.
number of ordinary shares outstanding. Number of ordinary shares outstanding. Oh, yeah. So that is the first one. Number two, I will be able to ask you to do the dividend cover. So, dividend cover. EPS over DPS. EPS over the DPS. I have done this question. So your work is just one to watch. I'm just trying to make it more specific. So the second user was they were talking about. Number two, they were need we talk about who?
Trade payables.
The trade payables. The creditors,
Yeah.
So which ratio can you use? So here we talk about mostly focus on the liquidity ratios. Because those are the one which shows that the company is done what? Has the ability to meet its short-term obligations. Are we capable to pay these people? Are we liquid? So like number one, we have which ratio? Which shows that we are liquid in paying these people?
Current ratio.
Current ratio. This is where now the current ratio comes in. The number two, acid test. Acid test ratio. You know the formulas. The number three, we talked about who? The user, internal
Management.
Internal management. So in this scenario, under internal management, we can focus on the turnover ratios. So because now the turnover ratios tells us what? Tells the company what? If it has the ability to do what? To utilize its assets. It has the ability of utilizing its assets for the purposes of obtaining efficiency in management of assets of the business. So in short, anyway, do the average correction period, average debtors, that is average correction period, or we say it, we call it debtors turnover in days. So are we in a position of correcting our debtors balances in the shortest time possible? That is why we do this, to test that. In which period will it take us to correct our debtors balances from the debtors? So that is the work of management, to make sure that we have money. So they have to do the correction as early as possible, using the least days. Another one?
Inventory turnover.
Inventory turnover, but I can like you to do the return on capital employed. This one would apply well here. Return on capital employed. So you look at the profitability. Who make sure that the company is doing well? In terms of, for the company to do well, obviously the management must contribute a bit. So the internal management. So We have to check on the return on the capital employed. It can apply here. This one. It can apply here. So you will be able to do that. So you know the formulas. You know the formula. So the only thing is that
Where does inventory turnover fall?
even you can add inventory turnover, but remember they needed just two. Eh? It's okay. Inventory turnover, which is okay. It can even fall here. So, but see, they needed just two. We give out two. So I wanted to give you two. But you can add others, even they become 3. Sawa.
That's all right.
And this one I have done it. And the same thing I've written here, they are done. They are in form of a video somewhere which you have. But make time, do them fast before you go to the answers. That is the end of this topic. There's nothing else.
Excuse me. Excuse.
Yes, you are excused.
On earnings attributable to ordinary shareholders, come again on that on those ratios. I didn't get earnings attributable to ordinary shareholders.
This is the EPS, earnings per share. How do you do it? It's the formula for the EPS. This is the formula for EPS. You say earnings attributable to ordinary shareholders. You divide with the number of ordinary shares outstanding. That is what I've written. So it's the formula for earnings per share.
All right. Okay.
Sawa Rose.
So,
Just a last question, Mwalimu. Is preference shares classified as equity or as liabilities?
An intergovernmental committee has been formed to create a legal framework to guide the
preference.
Of the
Yeah.
It matters, huh? Which type of preference are you talking about? Cumulative, non-cumulative, redeemable, irredeemable.
It is
Is it does it matter if it's redeemable? Is it classified differently or?
Yes. We have irredeemable and redeemable. And we have, when we talk about just preference share capital, that is an equity, when they are not specific. Eh? Okay. When they are not specific, that it's which type of preference. When they just say preference share capital, that is just equity. That is that one takes me to financial accounting. Eh? Let me show you something here concerning that question you have asked me. Another question?
Mwalimu, I wanted to request, I don't know whether it's possible, if maybe you are having notes on stock market ratios, you can share if you have, please.
Stock market ratios.
Yes.
It's a PDF I shared. It doesn't have that, other than the financial accounting notes.
Because I was checking on the notes you gave out yesterday, but I didn't see that part of stock market. And I tend to think that this EPS, it's coming from that area. Because I've checked throughout the notes, I can't see it anywhere.
But there is, other than those notes, there's no another notes you have. See, these other notes you have for ratios. Kuna notes zingine mko nazo za ratios. Hii si Wairimu. Wairimu, there's other, I think there's other notes you have for that. I will be showing you just a few. So there's this student who asked me about preference shares. I'm using these, my good students. Preference shares are shares held by financiers of the company. That is, investor owners of these shares are entitled to an income known as preference dividends, which is predetermined as a fixed percentage rate. Types of preference shares, we have redeemable, the one which can be bought back. Those are equities. But the non-redeemables are shares that cannot be bought back. You consider them as irredeemable. They are liabilities. And we have a convertible and non-convertible. We have cumulative shares and non-cumulative. So those are the types of preference shares. But when they say just preference, mostly in your level, maybe they can say redeemable or irredeemable. Redeemables are equity, irredeemable are liabilities. And then the other question which was asked about stock. There's this note. I would be writing before I end this session, because sometimes I end the session and I even forget to share. There's some notes I've said check in the group. Are you seeing those stock market ratios in those notes? The one I've written check in the group. A student who was having a question about stock market ratios.
Yeah, it was sent on which day? Yeah, I can see you've highlighted 13 pages, but
you don't have it?
I don't think I have it.
So it's in the group. You deleted,
I don't think I have it.
Meaning that you deleted even the others.
Thank you.
All right. Then there's a question which was not this one. This one I have shared. Use the one I've shared, the one which is typed. Then there's a question which another student asked about the marking scheme. Which sitting was that? Gideon. Gideon, you asked about this December, this one. And that one, if you are not seeing it, it has been shared. That is it. So now we can end the session. I have answered, I think, all your requirements. So next time when we meet, branch accounting. Question number 5 in the exam.